Welcome to the Just Build Wealth podcast. I'm Ryan Ross.
And I'm Mike Ross.
The Just Build Wealth podcast is focused on simplifying wealth building. If you're trying to understand the strategies, systems, and processes that go into building companies, assets, and wealth, you're in the right place. With each guest, we aim to dig into their business and the industry they work in to gain a better understanding of how they are building wealth for themselves and helping others do so. Andre Shevchuk is a partner at BPM, where he leads the tax specialty practice and focuses on things like the R&D credit, the employee retention credit, among other things. In this interview, we talk about how he pioneered a program to meet in the metaverse after a April Fool's joke went wrong, the basics of tax credits versus tax deductions, and what R&D credits are entirely. There's a test for determining if your program is considered R&D, and Andre outlines this test. We also talk about whether company size is a factor in getting R&D tax credits. We talk about the state versus federal tax credit system and things like uncertain tax positions. Ladies and gentlemen, Andre Shevchuk. Andre Shevchuk, thanks for coming on Just Build Wealth. Can you give us just a quick 30-second overview of who you are and what you do?
Yeah, hey Ryan, it's a pleasure to be here. Thanks for having me. Quick overview of who I am and what I do. I'm a partner at a regional tax firm called BPM, and I lead our firm's specialty tax practices, which includes things like the R&D credit, the employee retention credit, M&A tax, state and local tax, IC disc, and cost segregation. I'm also the managing partner of our Bay Area region, so administratively I'm responsible for those offices that fall under that umbrella. My direct experience is in the R&D credit and the ERC space, so I lead a team of 10 at the firm, and I help our clients to document, navigate, and defend those credit claims before the IRS.
Interesting. Should we start with the conversation about meta meetings?
Yeah, sure. Happy to talk about that. So from starting out last year, I had sent out an April Fool's joke to the entire firm with a picture of me with these Oculus goggles on, and I said something to the effect like, "Hey, we're starting doing all these meetings in the metaverse now, and if you ever want to get your free Oculus glasses, click this link." And in the link was a Rickroll, which is a link to a funny '80s song, commonly done as a prank. And I sent it out to the entire firm, and and a lot of people thought it was very real. so people were not clicking on the link, or they just weren't getting the joke. They didn't understand it was April Fool's Day, whatever the case was. A lot of people thought it was real. So including the CEO, who reached out to me and said, "Hey, what is this? Why I didn't get authorized you to do this." IT reached out to me, like panicking, like, "Did you get hacked?" Calling me like so, all this kind of stuff happening, and then we resolved it. Like, "Hey, this is a joke. It's a Rickroll, whatever." And months go by, and then CEO calls me and goes, "Hey, I realize that was a joke, but joke's on you. You got to do it now. Make it real." So that's how that kind of happened. But so what that means was, in effect, we're operating under this new normal, right? This new hybrid environment post-pandemic. Our firm has grown substantially over the last 4 years, and through the pandemic, we've hired a lot of people remotely, right? So we're having a lot more people in different states. People are not coming into an office; they don't feel the same connection they might have done in the past. And we are, as a firm, exploring ways to stay connected. Make people feel our moniker, which is BPM, stands for Because People Matter. And that's our brand, and that's how we go to market, and that's how we're competitive, and how we hire people, how we retain people. So this was seen as a potential tool, as a way to keep people connected and collaborating with each other. So we started off with a pilot program. We had 5 people, which I was voluntold to co-lead, and we explored different options of what was capable in the metaverse. So we were each given or had already purchased an Oculus to log into the metaverse. And then we tried to do different things with what Meta has provided. They have a product. And then we discovered later that there's other consulting practices out there that kind of navigate you through the metaverse to kind of to do these sorts of things for companies. And so we selected one particular vendor, and we've had a great experience so far. And we've expanded our pilot program from 5 people to 25 people. So we're kind of in the middle of that right now. So having meetings there and enjoying that experience.
Do you have, this is a side question, do you have meetings with clients as well?
We haven't had it yet, but the idea of these pilot programs was to see, what is a practical use of these things, these tools, right? So we got in there, got familiar with the tools. I mean, there's things you get in there, and it's just like a lot of the time, a lot of the experience you might have is having the same feelings as standing somewhere in a physical space with somebody. So there's note-taking tools, there's visual tools. You can bring your screen in, you can bring PDFs in. And so we're very wary about client information in any kind of client settings for anything. So we're taking some baby steps to see how these practical tools could be used. So for now, it's all internal for BPM. We haven't had any client meetings yet, but our clients like to hear the story. It's kind of an interesting and novel thing to be exploring right now.
Yeah, it's really, I mean, I hadn't thought about like a use case, but it makes total sense. Like, because it's a different experience, but at the same time, you're just meeting with people, right? You just happen to be wearing these goggles, and I guess you can't see the people wearing the goggles in the meeting. They just look like they're sitting there with nothing on their head, right?
Right. No, in the metaverse, where in this particular vendor that we're using, you upload a picture of yourself, and it renders a 3D image of your head. Your mouth moves, your eyes blink. You have arms and legs. So the arms and legs are kind of, and you pick an outfit. So your arms and legs in your outfit are kind of cartoonish, but your face kind of looks like they did a good job of rendering that in the 3D space. So you actually jump into a room. Sometimes the room is like overlooking Dubai. Sometimes it's on Mars. Sometimes it's in Chicago. But you definitely feel like you are occupying a physical space with somebody. And so when you enter a room, we call it, you kind of spawn. If you think of it you spawn like a video game. Wherever you spawn the same location, and instantly people like jump away from each other to like not invade your personal space. We had a guy. We had one of our IT people who was doing some of the investigative work behind the security of it all, and he was like, "Hey, I'm sorry I was late. I was taking a shower." So he's like, the concept of like being somewhere physically, he like felt like he had to get ready. Of course, he was there virtually. So we're like, "Oh, you smell great. Thanks for showering before the meeting." But it's very interesting, and you feel like you spent time with somebody, kind of like if you think you're like. If you go on a hike with somebody or if you're golfing with somebody, you feel like you spent time with them in a physical space. It's a little bit more meaningful than over Zoom. And that's really very apparent when you're in there.
How crazy. That's so interesting. We could go way down the metaverse rabbit hole, but we need to talk about tax credits. So I want to shift the conversation, and we have a very basic question about what you guys are doing, and in simplest terms, what is a tax credit, and how does that vary with a tax deduction?
Yeah, that's a great question. We get that question a lot. So I'll kind of share a story about how I got into this in the first place. So when I was coming out of school, I joined PwC out of college, and I was kind of told, "Hey, you got to pick audit or you got to pick tax." And so I said, "Well, I don't know." And my professor was like, "Hey, just say tax. You want to get a good job." So I said tax. I went into tax, and I was doing tax compliance. So you could think of your own personal return or a corporate return. You have revenue, and then you have things that deduct from revenue, deductions. And then you have taxable income, which is sort of like your profit on the tax side. And you have a tax rate. Right now, the tax rate corporate is 21%, and that gives you a tax liability. You got to pay that tax. Now, there's a credit below that. It says, okay, now you have tax credits to offset your tax liability. So that's the difference between a revenue and a deduction, takes away from your tax revenue. And then the tax credit is actually a dollar for dollar offset of your tax liability. So it's very valuable credit.
That's the key.
That's a really quick, high level difference between a credit and a deduction. The value of a deduction is sort of multiplied by the tax rate. The benefit it gives you is multiplied by the 21%. So if you have a $100 deduction, that's worth actual $21 if you were taxable.
Yeah.
Whereas the credit, if the credit is $100, the credit offsets $100 of tax liability, and
Got
that's
it.
worth 100, right? So it's definitely a valuable thing. But how I got into tax credits was, I got into this doing these tax compliance. I had a very large corporate client. I worked on it all year long. It was my only client, and I just drilled and worked them through all these tax softwares, and I was like, wow, this is like really doing homework all day. I didn't really enjoy it. And I had another group of people who were doing sort of consulting work, and some of that consulting work while I was at PwC was involved with these tax credits, and they kind of said, well, we're doing this little bit of different thing. And I said, well, what's that all about? And said, well, we have to talk to engineers and scientists, and we got to talk to, lab people and software developers and all the kind of things that are happening in the Silicon Valley where I am. And I said, well, that's really fascinating. You get to go talk to people and go visit them in their physical locations. And then you take what you've learned from them and translate that in the tax code, support them with the calculation and documentation, which is something that ends up on your tax return. But it was a whole different environment. I had no idea that it wasn't just audit or tax. You had consulting. There's international tax, there's state and local tax, there's M&A. There was all kind of a different spectrum of possibility that I had no concept of. I chose this particular area because it was interesting to me. You had time to meet with people and talk to them about what they did, and it was fascinating. It was kind of like story time a lot of times. So I really enjoyed that. Kind of used different skill sets than the typical accountant. You think of people with a green visor and they're stuck in a little room and they're just cranking
Yeah, the
away.
green visor. Yeah.
Yeah. So I got away from that, used some different skill sets, and really enjoyed that. Clients typically finding, saving tax never really goes out of style. It's, people appreciate it if they could save them on their taxes, which ultimately what we were doing. Helping them navigate complex areas of the tax code is also what we're doing. And I got to talk to all kinds of interesting people. At the biggest companies in the world. I've been able to visit nuclear reactors and go inside the reactors. I've been to, sand mines, and people were dynamiting the sand and
Really?
processing it into silica and all this kind of stuff. Anyway, so I've had this really different, broad experience than I ever thought I would have as a tax accountant. Which
Yeah, I was
sounds
gonna
kind of
say
boring.
you didn't realize you were gonna replace your green brimmed hat with a hard hat to
Right.
go into a
No, that's
mine.
right.
Given all the complexities that have arisen from the tax code really from 2019 on, has there been an evolution in tax credits over that time frame also that has really been a key issue with driving company growth?
Yeah, the tax credit has evolved significantly since I started doing this. I started my career in public accounting in 2005, and I started my work specifically on the tax credit side and R&D credit side in about 2007. And around that time, it was not permanent. This wasn't a permanent credit. So in the tax code, this was introduced in 1981. So this particular credit was introduced by the Reagan administration as a means of keeping high paying, good jobs, innovative jobs, and innovation inside the United States. That's the intent of this particular credit. And but it was always permanent. I mean, it was always temporary. So it was every other year it would have to get reenacted. And so we're kind of holding our breath as practitioners, and be like, is it going to get reenacted? And it had bipartisan support, so we always kind of felt confident that it would. But sometimes it would take a long time, as legislation does tend to lag sometimes, wouldn't get passed. So we'd have times where we're waiting on Congress to enact things. So but in 2016, through the PATH Act, it was made permanent. So the R&D credit is permanent federal credit. California also has a R&D credit, so there's that as well. But yes, the definitions of what is R&D, how to support it, the IRS's guidance on how the documentation is to be reported, all has been very fluid and changes over the last over 15 years I've been doing it. But yeah, there's been a lot of changes. I can talk a whole lot about that, but yes, it's changed significantly. It's a very generous credit, so the IRS pays particularly close attention to it and making sure that the people who are claiming the credit are worthy of that. So that's where we come in and try to help our clients.
In general, what is this R&D tax credit?
I wish I knew that. It's not very well defined in the tax code, but
But R&D stands for what? Research and
R&D, yeah,
development, right?
R&D is research and development. So in the tax code, there is a code section 41 that describes what R&D is, and it's sort of defined by a 4-part test criteria. And the first test is that your activities are technical in nature. So relying on computer science, engineering, or physical science would satisfy the first test. The second test is that your activities are in an attempt to develop or improve what they call a business component. And a business component is the IRS or Treasury's way of saying a thing. So a business component could be a product, it could be a process, it could be a technique, it could be a formula, it could be an invention, it could be computer software, algorithms, things like that. So you have to, the second test says you're attempting to develop or improve something in terms of its functionality, performance, reliability, or quality. That's the second test of the 4. And then the third test is that while you're attempting to develop your thing, your business component, there has to be an evidence of a technical uncertainty or uncertainties related to your capability or the method that you would use, or trying to find the most appropriate design or solution. So the key to R&D is really like uncertainty at the outset. That's really the critical part of how you would define what is research and development activity. And then the fourth test goes with the third test and just says that in your attempt to overcome the challenges that you're faced with, you have to exhibit what they call a process of experimentation. A process of experimentation can be simple as evaluating alternative solutions. It could be trial and error testing. It could be systematic testing. It could be basically aligning with like the scientific method. So that becomes the 4-part test, and it's applied to, say, an overarching project or product that you're attempting to develop. So not very well defined, but it's vague, and it's meant to be vague so that a lot of different types of companies can take advantage of the credit and get this tax savings.
I feel like you could be very creative.
Probably don't like to use that word creative, but yes, we have very loose interpretations, or we have very strict interpretations. The practitioners in this space may see things as R&D eligible, and the IRS may differ on that opinion.
So that's a great segue. So given the fact that there is a very defined 4-step process to state it, is there an equally defined process to defend it? Because that's essentially, if I'm reading this right, that's basically what you guys do, is you find ways to defend that process. Is there multi-steps that are kind of common practice?
Yeah, so there are multi-steps that could be considered common practice amongst R&D credit professionals or people who work in my space, and but traditionally we look to what it says in the tax code as far as what is required for documentation, and that is a very, very broad definition of what is required. So it's really anything that could be used to substantiate your deduction or credit claim is what they ask for. So it's just documentation in general. But over the years, we have case law, we have the audit technique guides, which is guidance that the IRS produces to look to see what are they really looking for. So it usually gets down to they like contemporaneous documentation, meaning documents that are produced at the time that work was being performed. So you could think of things like, the best case would be like time tracking data or logs into systems or notes taken by scientists, lab books, all kinds of things that you would think of like, how would you support that you were doing these things? And so it could be email, it could be calendars. It could be all kinds of different types of documentation, but the more the better, right? So the more documentation you have to support your credit claim, the better. And it's always an exercise of ways to do that. There's just totally different ways to come up with the documentation and battle with the IRS to make sure that your credit claim is solidified.
So a question about, I know that obviously you guys probably work with a lot of different industries and helping them defend their tax credit claims. Are the claims between industries different in terms of, I was looking on your website and it says you work with winemaking and like fintech companies, right? Which to me are very different. but maybe they have similar defense processes. I don't know. What are the differences between industries?
Yeah, I mean, industries have, different favorability, or they're favored by the IRS more than others, right? Because you think of somebody like developing a compound or a drug for curing cancer. There's a scientific process that has to be undertaken, that has to be approved by the FDA, and that process is very regimented. It's very highly documented, and so there is, in fact, the IRS has a safe harbor if you do meet certain criteria that fall under those pharmaceutical guidelines. Then that is one of the best cases you should have for R&D. But that's not to say that there's things in there that you can't just assume are all qualified. So, for example, things that are not qualified for the R&D credit are like foreign research. We want to incentivize that work to be done in the United States, so you have to exclude that. Sometimes there's pretty complex collaboration agreements with other third parties. So, whose R&D's expense are you entitled to, right? If someone's funding you, you don't necessarily get to claim credit on your expenses that someone else is going to take on your behalf. So, there's all kinds of things that particular one is pretty interesting, because you would think that's a pretty clear cut case. But then you have another extreme, like where maybe you have like a construction company or a winery or name the industry that might fit into that 4-part test criteria. When you're looking to those activities, there's so many different types of industries that take advantage of the credit. Although historically, in the United States, 75% or so of credit claims are manufacturers. So you may not think of that off the top of your head, but you have to do a really good job to document how your activities meet that criteria. And so it's a never-ending job for me. So it's like there's never-ending things to learn. There's financial statement implications of the credit or deferred tax assets. There's all kinds of concepts behind financial statement R&D and how it connects to tax R&D, and I've never stopped learning since I've started.
Well, you mentioned something about whether the research is going on in the United States versus other countries. Are R&D tax credits, do they exist in other countries also? And do companies think about, okay, where do we want to do the R&D based upon the tax credits in our tax returns in those different countries? Is there a geographical play here?
Mike, I feel like I've teed you up for these questions, and I really didn't. Like, this is a great question. So going back to my story about how the R&D credit in the United States was generated in 1981, at the time of the OECD countries, the United States was the first to have such an incentive. So it was very powerful to have that type of tax saving opportunity and provide innovation and high paying jobs in the United States and encourage that investment here. Particularly back then, we were losing ground in automotive space, or perceived losing ground from German companies, and we were losing ground in the 80s with electronics manufacturers in Japan. So we were trying to keep competitive with those types of changes in the landscape to our economy. So fast forward to this year, I think that of the OECD countries, there's many countries that offer very similar R&D credits. Canada and Australia and the UK. China has a super deduction, and of all those countries, we're about 27th in terms of generosity of like the 35 or whatever number of. Yeah, so we've fallen way behind, and so Congress has a need to catch up, and so they've done interesting things like with the PATH Act I mentioned before in 2016. They offered the R&D credit, which is traditionally used against your income tax liability. They offered a pathway for startup companies to use the R&D credit against your payroll tax. So as you can imagine, many startup companies aren't paying income taxes. They're operating in losses. They're developing their product. But now, if you are eligible as a what they call a qualified small business, you can offset your payroll taxes up to $250,000 per year. And not many startup companies know that. Not many local CPAs know that. So it has to be done on a timely filed return. So some people miss it, and it's a bummer when they do. But going back to what you're saying, the U.S. was first in this type of incentive, and we're falling a little bit behind, and Congress is aware of that, and so they're trying to enhance the R&D credit for taxpayers.
So you gave me another interesting segue, Andre. You mentioned startups. Is there a certain level of, I don't know, payroll, revenues, assets where exploring R&D tax credits makes sense versus don't make sense? Is there a size of company metric there that screens out things that just aren't going to work from your perspective?
There is, and I would say first that if you are due an R&D credit, there's no reason you shouldn't pursue it. I think that's first and foremost. If you are developing software, or if you are in the pharmaceutical space, or you're let's say you're developing a new game for a mobile application, there's an R&D credit that's available for you that you should be taking advantage of that savings. It's a huge catalyst for a lot of companies. But in our space, we see companies getting more scrutinized when their credit becomes larger, right? The IRS can't go after everybody, and we don't say we're going to play the audit roulette. But you do want to do some more diligence and more documentation when your credit gets larger. So when you start to spend about $1 million of quote unquote R&D spend, you may have a federal credit of around $80,000, or maybe a little bit more, depending on your circumstances. And so then you want to start paying more attention to what documentation has to be required, what the IRS expects to see in terms of a deliverable or supporting calculations. So around $1 million.
Gotcha. Makes sense.
I have a question about the pioneeringness of the companies that are applying for these tax credits, or that could be applying for the tax credits. Do they need to be creating brand new things, or can they be like researching or developing something that already exists, but they're kind of putting their own new spin on it?
Yeah, Ryan, that's a great question. And it is, in fact, not have to be brand new. The uncertainties you're facing don't have to be brand new to the industry. They sort of have to be uncertain to you. But the second criteria, and part of that 4-part test I mentioned earlier, is that the business component can be new or improved, an improved upon component. So they have examples in the code. Some of them are a little bit archaic, but they reference like a motorcycle engine, and maybe the motorcycle engine is not new, but maybe you're adding some new type of fuel injector to it. And so that piece of that effort is uncertain to you. How do you want to measure the performance of that new component? And therefore, that part of it can be construed as R&D, whereas the housing or the motor that is no longer, there's no uncertainty there. That part of it no longer R&D, but the subcomponent is.
I see. So it's almost like you're spreading that design into its component parts and saying like, oh, this part is new, but this part isn't new. So we can apply the R&D to the new part effectively. That's
right. It all gets back to uncertainty. It always goes back to the 4-part test. So the components that you're uncertain of, or how it will perform, and kind of people also construe sometimes that they think that R&D has to be successful, when in fact, failures are sometimes the best cases for demonstrating R&D.
Yeah.
Because it demonstrates you were uncertain. It proves it.
So I guess this is a great example of the government actually like incentivizing people to take risks and to try to fail, because if not, then how are we going to advance, and how are we going to lead in the world? Interesting. Well, actually, I was reading a book and Amazon came up and they were talking about, we try to fail all the time. And Bezos was talking about, we developed the Fire Phone and that was a huge failure, but that's nothing compared to the other failures that we'll have. So I'm going to connect it to this in that are surprising organizations or companies, or are they taking use of these tax credits, or are there people that haven't taken advantage of the tax credits that should be doing it?
Yeah, absolutely. There's I think that the R&D credit is underutilized. I think when you think of the Amazons and the bigger companies out there, they're definitely aware of it, right? They're taking advantage of the credit. They're going to get every penny because it's very valuable, and they have internal teams. They don't even use consultants. They have internal teams to help them calculate the credit, to document it, They may be in continuous audit with the IRS over those, disputing what is eligible and what is not, which is kind of common sometimes as well. But what does get overlooked is sometimes when you're in industry, it's not completely obvious to you that you're doing R&D. The definition of R&D in your mind could be like the guy in the lab coat with the beakers
Yeah,
and
yeah.
things blowing up. When in fact that's a very common conception that it has to be some kind of super high threshold of innovation that isn't really the truth. That's not really correct. So a lot of times startups get overlooked because maybe they are doing R&D and maybe they are aware of the R&D credit, but maybe they're not aware of the new potential ways to monetize the credit with a payroll tax opportunity. So manufacturing is another one where oftentimes it's overlooked because that's not your sole focus of the business. Maybe your sole focus of the business is production, and so you're spending time there. But maybe you have 10 engineers on staff to improve yield or improve process improvement, or you taking on a new equipment on a new line, or developing new product, and you're solely focused on the production side. You may not be aware that there's an R&D credit available for you.
Quick question about just a specific type of startup or small business that would be interested in this. And then I think we want to talk about ERISA and things like that. So my question is, a lot of people in our audience are going to be financial advisors, individual advisors, right? And they may not be creating new products that are specifically, it's not a manufacturing job, right? This is a service profession. Are there types of things that might be overlooked by this type of company that you have seen people, they put through the tax credit and it actually works?
Yeah, that's a good question. So service companies are not prohibited from claiming a credit. I would say that if you're looking at it from that angle, sometimes you have like people who are investors, and the company's not recognizing that there's an R&D credit, and there's a big value there for the investors, such that the company should claim a credit and experience those savings. Private equity is a good example of that. So people are in funds and maybe investing in a company that's either a startup or is developing software and providing software as a service, or there's all kinds of tech blank as a
Yeah,
service, right?
yeah.
So a lot of those companies should be claiming the credit as well. But from a standpoint of yield on your investment, this is drops dollars to the bottom line immediately, right? So from an investor standpoint, it's good to be aware of that this program exists, and that can help the companies that you are overseeing or involved with, or maybe you're on the board of a company and they're not aware of this credit. Another credit we probably should talk about in that standpoint is the employee retention credit. So I don't know if you wanted to talk about that, but from an investor standpoint, that's a very hot topic right now, and it's something our firm is really helping companies to navigate.
So why don't you spend 2 or 3 minutes talking about the employee retention credit, Andre?
Yeah, the employee retention credit was something introduced with the CARES Act of 2020. So this was part of the same act that introduced the PPP loans that people were, you may be familiar with, and people were clamoring to get that PPP money to help support them during the pandemic and save them from economic disaster. The other provision there was the employee retention credit, and initially it said if you're going to take the PPP money or use that forgivable loan, you could not also claim this employee retention credit. And the employee retention credit was a payroll credit that was allowed companies who were eligible to claim a credit on their employees up to $5,000 per person in 2020, or up to $21,000 per person in 2021. So this is one of the most generous credits out there, and it was fully refundable. So as a payroll credit, you would apply this credit to your payroll tax returns, form 941, and the amount of payroll tax that you had already paid in, you would get refunded, and then any excess of that amount would be refunded back to you as well. So this was a hugely generous credit that people overlooked because, like I said, initially it said that you could not claim both PPP and ERC. The IRS subsequently walked that back in a notice and said, oh, by the way, you can claim the ERC if you had also taken the forgivable loan, and you can claim this credit retroactively. So the program was available starting in Q2 of 2020, and it ended in Q3 of 2021. But you have a statute of limitations to see how long you could look back, and if you were eligible to claim a refund by filing amended payroll tax returns, which we're doing a lot right now. I know I said a lot there, but there's a whole lot I could talk on and on about. But that is, it's more generous than the R&D credit. It's more applicable because it doesn't have the same type of restrictions. There's two paths to eligibility. That the first path to eligibility is to determine if you had a significant decline in gross receipts or top line revenue when compared to your 2019 quarters. So if you compare 2020 to 2019, those individual quarters, and you saw a decline of 50% of revenue, we saw a steep decline because people were sheltering in place or doing what they're doing, then that would make you eligible for 2020. In 2021, the eligibility requirement was lessened. The bar was lowered. So you could claim a credit if you had a decline in gross receipts of 20% when compared to the same quarters in 2019. So a lot of companies right now are still, you've probably seen or heard advertising. It's all over the radio. It's on billboards and things. But our clients are getting emails blasted at them. But still, we're finding that many potentially eligible taxpayers have yet to claim the credit. So the other path to eligibility was whether you were partially or fully shut down due to a government order in more than a nominal sense. And more than nominal in this case means 10% or more of your business was partially shut down or fully shut down due to a government order. So I'll stop talking there because I know I just rattled off a lot, but I can easily talk your guys' ear off about the retention credit.
So let's shift back to the R&D credit. You mentioned both that's at the federal level and also at the California state level. Okay, so I'm back to my arbitrage question. Is it just California among the states that has this R&D tax credit, or is that a competitive thing around the United States?
It's also competitive around the United States. So I think the majority of states offer a similar type of credit. Usually it starts with the definition under the federal credit. So they kind of state statutes start with what the federal definition is, and then kind of make some minor adjustments about what the credit might be, the credit rate would be. So California is a huge supporter of the R&D credit. Arizona is one of the most generous state credits. Texas has a credit. Massachusetts. We kind of see these over and over again. We're kind of hubs of innovation and manufacturing and startup companies are located. So Florida has a credit, but it has a limit to how much credit you can apply for example. So they kind of cap it, which is interesting. And other states like Pennsylvania have an application that you have to go through, similar to Virginia. So there's a lot to learn on all these fronts. But we're fortunate in that we're mainly based in California, and most of our clients are in California, so they benefit from that state credit.
Excellent. And any other entities or any other taxing agencies that do these kinds of credits, or is it just state and fed?
You mean like local municipalities and things? I'm not really aware of like a citywide. I think when we look to see cities imposing tax, I don't think there's a credit per se available to them. But some states like New York have certain programs. They call it New York's program is the Excelsior program. So they kind of have a different, unique spin on how you claim those benefits. But we don't see it at a county or city level.
Your website had just a statement saying the the R&D credit is one of the IRS's most commonly reported uncertain tax positions. What does that mean?
That's a good question. So for reporting purposes, if you have an uncertain tax position, which has certain definitions of like what that means, like what you're uncertain of exactly, but there are things that are in the tax code that are not really crystal clear. One of them being, for example, transfer pricing. So transfer pricing is when you're having cost arrangements with like foreign entities, and maybe you have intellectual property in a subsidiary in China, for example, and you're paying the Chinese subsidiary, which is kind of your left hand paying your right hand, and you're paying them on a cost plus arrangement, and then you have to document that is in fact a valid arrangement. And there's a whole, I'm not a transfer pricing expert or international tax expert, but as you can imagine, there's a lot of uncertainty with regard to what is a third party transaction that's eligible under those rules. So that transfer pricing actually is the number one most reported uncertain tax position. Number two is the R&D credit. So it's up there, but so basically the definition I provided to you earlier is very broad. Like I mentioned, it's very vague. And so interpreting what types of documentation is necessary exactly to support that credit is an uncertain position. So usually document that on your tax return under Schedule UTP with some language in there to cite exactly why you believe that the position is uncertain. The IRS has more recently asked for like additional, they want more detail. This is why the position is uncertain. And then for financial statement reporting, a little bit different, but it's kind of a similar concept. For financial statement reporting, if you are issuing financial statements, you may document that you have a reserve against your R&D credit, which means that your management would be saying, well, if we were to get audited, we think we have calculated the credit correctly. There's certain elements of the calculation that we feel like it's not super clear, and we're going to reserve, say, 20% of this credit to be lost in the exam. That's kind of a common approach. So that's
lost
what I mean
in
by
the exam.
Yeah, the exam by the IRS, the auditors from the IRS, they call it an examination. So when the credit is claimed, the auditors may examine you, and then they examine the R&D credit and they say, you know what, we don't really like these job titles, the people who are working in this space, or we don't really agree with that. You're contractually obligated to pay this certain contractor. So that may be a weakness in your R&D credit claim that you want to acknowledge on your financial statements. And you may acknowledge that as well on your tax return. So those are uncertain tax positions that sort of have to be accounted for.
Okay. As an individual filer,
you can imagine like me as a brand new associate at a big firm and trying to wrap my head around tax in general, and then you go into like this level of like depth of like one particular subject. It's like it's so interesting that this was even a thing to do, right?
Yeah.
But here I am now years later, and I gathered all this information over 17 years of practicing this kind of stuff and dealing with the IRS and dealing with the franchise tax board and learning. So it's great to I'm kind of like word vomiting at you, but I'm happy to talk about it.
I think it's funny. I feel like I'm in an uncertain tax position because I'm like, hopefully I'm getting all this stuff right. But I suppose many individuals think this way as well, but neither here nor there. Question, we know what the FTB is. That's the Foreign Franchise Tax Board. How do they relate to the IRS?
Well, they're very similar in a lot of respects. So the FTB is commonly thought of as the IRS for California, right? So that's their jurisdiction, and they would review your California claim, or they would review your return in general. So very similar to the IRS. They have their own sort of guidance that they produce. They have their own guidelines that they want you to follow. Their agents, can be particularly aggressive in the R&D credit space. But it's a very similar approach to the IRS.
I see. Does each state have one of these?
Yes. Yeah, each state has their own. I mean, if you pay income taxes, or there's an income tax authority to help you review. It could be your individual return. It could be your corporate return. It could be a partnership. They have different bodies to make sure that you're claiming those, filing those returns correctly, which includes credits.
Oh, interesting. Wow, it's just tax goes so deep. I read that the tax code is, I think, 30 pages of things that you have to pay tax on, and like 70,000 pages of things that you can claim a credit for.
That's funny.
Which sounds great, but you gotta know all those pages.
Yeah, no, the tax code is quite voluminous, right? So it's hard for you to wrap your head around any one particular area, So even you may have a CPA or a tax professional, and you kind of lean on them for advice and to know a lot of things. And they may very well be a really good general practitioner, but they don't have the time to commit to be a specialist, which is kind of where where I have a job and where I've had a career is specializing in this particular area of the tax code. So it's a little bit more unique. I think sometimes people shy away from being dived too narrow into a particular topic, but it was for me. I really enjoy it.
Sounds like it's you're in the right place at the right time, and you knew those things, so it worked out really well.
It did. I've had some very unique experiences and heard people, developing the F-35 and people making hybrid tanks and all kinds of neat stories about
the F-35 being like a jet or a plane.
Yeah. I think one of my clients a long time ago was I was working on the East Coast in Virginia, and they were part of their mandate was to develop the fuselage. So heard from them and helped them to claim a credit.
That's kind of cool. Well, with that, let's jump to the final 4 questions. The first one is a question about any 3 favorite books or references or media that has guided your thinking. Maybe it was a business book, or maybe it was a book about creating a jet. Maybe it's a tax code. What's guided your thinking in terms of interesting media that you've seen recently?
A book. Gosh, that's hard to say. I mean, kind of off topic a little bit, but when I was in college, I read Robert Kiyosaki's Rich Dad, Poor Dad.
Yeah.
And that had a good influence on me in terms of finance and time value of money and that kind of thing. So that caught me at the right time. So that was one thing I thought that was a good book. More recently, I leveraged Bloomberg's BNA, which is something that is a tax resource for us that we can leverage. But I know some of the authors that developed the BNA personally, and so it's kind of interesting to read that. I don't call it a book, but
it's called Bloomberg's BNA.
BNA, yeah. I don't remember off the top of my head what the
I'll find it. I'll find it
acronyms
somewhere.
are. But it's a document that's put out to sort of discuss all aspects of this deep dive into the R&D credit space and the underlying Section 174 deductions.
Interesting. Next question is tools that you love. What are some tools that you use in your profession or just maybe at home that you think everybody should be using this?
Tools. Well, the one tool I just mentioned is we operate with tax research, right? So we are constantly having to navigate these rules that are quite complex. So tax notes today, RIA research, CCH, Bloomberg, those are the tools that we use to leverage and find answers to things. And I wouldn't say it's a tool, but what the most powerful thing that I have to leverage is my network. Mm-hmm. So over the course of the years, there's not too many people who operate in this very narrow space, and you tend to get to know them pretty quickly. And over this past year especially, a lot of firms have come together. We don't really see each other being too competitive. I mean, we're all competing for clients and things like that, but there's so much work to go around that. We've come together in these little clusters of think tanks. Yeah. And so as a tool, that's the most powerful thing that I have to do is to bounce ideas off of other R&D credit professionals in the country.
Mm-hmm. And I'm guessing a close third would be the Oculus Rift.
That's right. I was going to mention that one, but I kind of see that as like the first iPhone. It's like it's really neat. Sure. It's come out and it's got a long way to go. Yeah. But right now it's a fun shiny object to play around with.
Yeah. What's a thing that you like to do outside of work?
I'm big into being out and outdoors. I was snowboarding this past weekend in Tahoe. I have a big backpacking trip planned for this summer in the John Muir Trail.
Nice.
Anything outdoors, I'm up for that.
Mm-hmm. You're living in the right place to do that. Love it. Last one. How can people find you?
You could look me up. Andre Shevchuk. My last name is a mouthful, but if you Googled my name or Googled BPM and search for R&D credits, you could find me there. My email is ashevchuk, ashevchuk @bpm.com. And you can find me there.
Perfect. Well, Andre, this has been a really interesting conversation. Going in, you think, oh, taxes, this will be heavy. But it was really informative. I had a great time. We covered a lot of ground. But thanks for coming on the show. And I think next time, if we can get you on, we can talk about like mining and F-16s and stuff like that. That could be a lot of fun.
That's right. Thanks, Ryan. Thanks, Mike.
Thank you. Thanks, Andre. Appreciate it.